Now, the shares of sugar companies were amongst the top gainers earlier this week on news reports that the government may allow higher exports in January. Now, some stocks saw a rise of up to double-digit percentage points, upwards of 10%, as seen in the chart on your screen right now. Mind you, this isn't a stock recommendation for you to invest into them, but merely a representation of the movement seen in the shares of sugar companies. So what led to the sudden rise in the sugar companies' share prices? Well, we will cover just that in today's episode as we look at some of the announcements made by the government this week that aided the sugar industry. Additionally, at a time of an anticipated global recession and the ongoing prolonged funding winter for startups, one particular business or ecosystem has just received the Decacorn status. A Decacorn is any company with a valuation of $10 billion or more. Now, while we look at the factors which have supported this particular business or ecosystem into becoming a Decacorn, we will also understand the road ahead for them. Want to know which company I'm referring to? Stay tuned. You're watching Informed Investor, the third empire, an initiative by Research and Ranking. Let's begin. Now, the shares of sugar companies were amongst the top gainers on Monday. There were two reasons for this. First one, in the 48th GST Council meeting held recently, the central government had declared reduction in GST on sugar from 18% to 5%. Now, market was abuzz that it would lead to a rise in the business volumes of sugar, which will improve the margin for the sugar companies. And hence, this was the short-term trigger. The long-term trigger is the central government's target to double its ethanol blending from the existing 10% to around 18 to 20% by the end of 2023. So the demand for ethanol from sugar companies are expected to remain elevated for a long term. But what does ethanol have to do with sugar companies at all? Let's look at that. What is ethanol exactly? Ethanol is a biofuel that is produced from biomass such as sugarcane, corn, or wheat. It is a clean burning fuel that can be used to power vehicles and reduce emission of harmful pollutants such as carbon monoxide, hydrocarbon, and particulate matter. In addition, ethanol is a renewable resource that can be produced domestically, which makes it an attractive alternative to fossil fuels. Now, the Indian government has implemented a number of initiatives to promote the use of ethanol as a transportation fuel. One of these initiatives is the National Policy on Biofuels, which aims to increase the production and the use of biofuels within the country. Now, under this policy, the government has set a target of blending 10% ethanol with gasoline by 2022, which, by the way, it has already achieved as well. Now, the government has also established a network of ethanol blending pumps across the country to make it easier for consumers to access ethanol blended gasoline. Nowadays, it has become very common to locate a banner at a fuel outlet stating that the petrol they sell contains ethanol. In fact, a lot of printed bills also come up with the added information that the customers are being provided with petrol which is blended with 10% ethanol. Now, what exactly is ethanol blending, you may ask? Ethanol blending with gasoline, also known as ethanol fuel blending, is the process of mixing ethanol with petrol to create a fuel blend. Now, in India, ethanol blending is an important policy implemented by the government in order to reduce the dependence on imported fossil fuels, reduce greenhouse gas emissions, and promote the use of domestic renewable resources. Now, overall, the use of ethanol blending in India is an important step towards reducing the country's dependence on fossil fuels, improving air quality, and promoting the use of domestic renewable resources. So why is ethanol blending attractive for the government? Now, there are four larger reasons. The first one is a reduction of import dependence on fossils. Now, ethanol blending with gasoline can help reduce the country's dependence on fossil fuels because it is a biofuel that can be produced from domestic renewable resources such as sugarcane, corn, or wheat. By increasing the use of ethanol as a transportation fuel, India can reduce its reliance on the imported fossil fuels, which can have economic benefits to the tune of an annual savings of about 30,000 crores on complete implementation, of course. Second is the lower emission through the E20 fuel. Ethanol blending to the tune of 20% reduces hydrocarbon effluents by 20% and carbon monoxide by about 30 to 50%. Additionally, ethanol blending can help improve air quality because it is a clean burning fuel that produces fewer harmful emissions than gasoline or petrol. Now, by using ethanol blended gasoline, vehicles can produce fewer emissions of pollutants such as carbon monoxide, hydrocarbons, and particulate matter, which can help improve air quality and protect the public health. Now, third is the overall improvement within the economy. Now, the use of ethanol blending can promote the use of domestic renewable resources. By increasing the production and the use of ethanol, the country can support the growth of its domestic biofuel industry, which can create jobs and economic opportunities, as well as support the development of new technology and innovation within the field of biofuels. Overall, the use of ethanol blending in India is an important policy that can help address a range of challenges related to energy security, air quality, and economic development. The fourth, of course, is the additional income source and employment that it provides to farmers. Now, what are the measures being taken by the government to promote ethanol blending? Now, while the blending policy has been there since 2002-2003, the average blending with petrol ranged between 0.1 to 1.5% till 2013-2014. However, in a series of policy intervention measures taken by the government since 2014 has resulted in the ethanol gaining more prominence in the energy mix since then. Now, India has achieved the target of 10% blending 5 months ahead of its schedule. The national policy on biofuels notified by the government in 2018 has envisaged an indicative target of about 20% ethanol blending in petrol by 2030. However, considering the encouraging performance seen already due to the various interventions made by the government, the target of 20% ethanol blending was advanced from 2030 to fiscal 2026. Now, investing in ethanol in India is a relatively new concept, but it is gaining traction as the country looks to reduce its dependence on fossil fuels. Now, to summarize, ethanol is an alternative fuel that is made from renewable sources such as corn, wheat, and sugarcane, and it can be used as a petrol additive to reduce vehicle emissions and as a replacement for petrol in vehicles that are designed to run on ethanol in India. Now, the government has implemented a program called the Ethanol Blending Program to promote the use of ethanol as a transportation fuel. Now, under the Ethanol Blending Program, the government mandates that a certain percentage of ethanol be blended with petrol. This percentage varies depending on the state and the availability of ethanol. Now, the goal of the ethanol blending program is to reduce the country's dependence on fossil fuels, decrease emissions, and support the domestic production of ethanol. Investing in ethanol production, therefore, in India can be a potentially lucrative opportunity as the demand is likely to increase with the government continuing to implement the plan and promote the use of alternate fuels. However, it is important to carefully consider the potential risks and challenges of investing in ethanol production, such as the market fluctuations and the competition from other producers. It may be helpful to seek the help of a financial advisor or a professional before making any investment decisions related to ethanol. Talking about the business which has recently earned the Decacorn status, IPL is now a $10 billion business. Now, as per DNP India Advisory's report named Beyond 22 Yards, the Indian Premier League just got the Decacorn status after its valuation crossed $10.9 billion in 2022. In 2020, the IPL was valued at $6.2 billion. The value of the ecosystem had registered a 75% growth in dollar terms since 2020. The growth in the value of the IPL ecosystem in INR terms is about 90%. Since then, the USD's appreciation in relation to the INR has taken away 10% value in the USD terms. Therefore, the value would amount to around $12 billion in constant currency terms had the appreciation in dollar not happened. Now, the IPL ecosystem represents the value generated by the IPL as a business collectively. The ecosystem consists of BCCI franchisees and the media right owners. So, what are the factors which have pushed the valuation so high? Now, a landmark event this time was the auction of the IPL media rights for the period of 2023 to 2027. For the first time, the media rights were spread amongst different broadcasters, breaking the monopoly of a single company. Now, the league sold the broadcasting rights at $6.2 billion, registering a threefold jump compared to the previous 5-year cycle in 2017 to 2020. Star India has backed the television rights for 23,575 crores, whereas Viacom backed the digital rights at 23,758 crores. This is the first time that the IPL media rights got split between two different right holders. Additionally, the IPL tournament in 2022 registered a record-breaking combined viewership of 426 million viewers on television as well as the OTT platforms. The IPL ecosystem's value is primarily driven by the above $6.2 billion media rights deal by BCCI in June of 2022 and also the auction of two new teams in the array, which is the Gujarat Titans and the Lucknow Super Giants in October 2021 for a combined value of $1.6 billion. With this, the average price tag of any team has seen almost a 16-time jump from its inception. Now, according to the report, the renewed media rights deal was the major contributor towards the substantial jump in value. Apart from this, the number of matches are also going to be increased from 74 to 94 matches, and the time duration of the league has been raised to 2.5 months. Additionally, newly signed sponsorship deals, higher ticket sales, and in-stadia revenue, given that the restrictions are now lifted, are all the factors contributing to the increase in the IPL ecosystem's value. Now, one trend that is developing from the IPL ecosystem is the existing club owners buying stock in emerging international sports leagues as well. This is also known as the multi-club ownership model. So what exactly is the multi-club ownership model? The multi-club ownership model has been common in the footballing world, and it is shifting to the IPL franchises as well for their long-term strategy. To explain the multi-club ownership model better, I will take the example of KKR. The Knight Riders group, which owns and operates the IPL team Kolkata Knight Riders, owns the rights to Trinbago Knight Riders in the Caribbean Premier League and a franchisee of the UAE T20. It also has plans to build a cricket stadium in Los Angeles in USA in partnership with the Major League Cricket. Likewise, Mumbai Indians, the team owned by Reliance Industries, recently unveiled two new franchisees in UAE's T20 League and Cricket South Africa's T20 League. Owning several clubs in several leagues has many benefits. By increasing operational efficiency and the utility of support and coaching staff across leagues, it enables a team to realize economies of scale. Additionally, it supports ongoing fan engagement all year long. From a branding standpoint, all teams may operate under a single name, which expands the fan bases and also the reach internationally. As a result, the globalization of fan bases, monetization options are created across regions, which will help previously unavailable or intangible revenue prospects and the licensing and merchandising as well. Now, IPL is regarded as the second biggest sporting league in the world on a per match broadcasting fee basis. Now, in order to determine the per match fees, $6.2 billion revenue from the broadcasting rights is divided by the total number of matches in the 5-year period, which equals to about $15 million per match. Now, the BCCI also plans to launch the women's IPL with a base price for a franchisee of about rupees 400 crores or $50 million. Now, the media rights for the digital version was contested most fiercely. Increasing internet and smartphone penetration, comfort of use provided by OTT platforms, and the demographic profile of India are some of the reasons which has boosted this. However, on a broader scale, IPL is significantly behind in terms of ad rates when compared with some other major leagues. For example, a 10-second slot for an ad during IPL 2020 costed nearly $20,000, whereas ad rate in other major competition leagues like the NFL or the EPL was around $1 lakh. Now, drawing this comparison, the IPL has a lot more space to grow in the future, and the advertising can be a major driver of revenue to sport broadcasters. Furthermore, the introduction of 5G services, greater penetration of internet, and increased smartphone usage will add to the rise in viewership. IPL would be one of the most profitable new age startups in the country if it is compared to other unicorns and decacorns in the country. Since its launch in 2008, IPL has reimagined the nation's cricket competition. It has witnessed major milestones and mesmerizing games through the likes of the IPL, etching in the hearts of millions of fans. That being said, for investors like you and myself, IPL has provided many investing opportunities both via the listed and the unlisted route for us to be able to ride along and make the most of the ecosystem's growth. And guess what? It is expected to get even better from here on. With those as the concluding remarks, this is Raj Mehta signing off, wishing you and your loved ones a Merry Christmas and the best of the festivities ahead. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.